You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. Stocks traded a tight range this week as concerns over news of China's fast economic growth overshadowed a mostly upbeat U.S. earnings season and better than expected reports on initial jobless claims and U.S. home sales, as well as other positive U.S. economic data. Disappointing earnings from Goldman Sachs Group and earnings projections below expectations from American Express helped to add a little bit of pressure to stocks during the week. All total, the pressure was enough, though, for the market to have its first significant pullback since November. Enter Steve Reitmeister, our editor-at-large, to help us understand the overall big picture here. And the question for the big picture is, are the bulls still in charge?
Yeah. Well, by saying that, it's almost like, do people with rose-colored glasses still in charge? And I don't think it's rose-colored glasses. I think what it is we have a clear economic improvement taking place around the world, in particular in the United States, and that's leading to better earnings outlooks, and people are feeling a little more comfortable about the economic conditions, that they feel that they can be successful in stocks. And so you could say the bulls are in charge, but really, economics and sanity are in charge, and that's why the market is pressing towards highs.
All right,
yeah.
A little bit of common sense thrown in there.
Yeah, absolutely. And the a lot of that double dip talk is now being pressed to the back. I mean, we got our problems, there's no doubt about it, but I think the probability of those things was completely overestimated.
All right, you wrote this week that we may see some choppiness coming into the market here over the near term. Anything to get concerned about there?
No, I don't think so, and certainly we saw that this past week. And so the reason why I wrote that is when we go back to September or October of the past year, September the market rallied nearly 10%, leading into earnings season, and basically it put expectations a little too high. So even though earnings were terrific, it may not have been as great as some hoped. So you have a choppy October, and then November and December were rallying again because corporate earnings were good. So here again, December was very strong, and so now our expectations a little too lofty for this earnings season again. So I expect some choppiness, some unevenness in the market, but still the early earnings story overall is strong, and then I expect that to lead to greater highs later in the year.
Okay. You also wrote this week that stock market has come a long way over the past 2 years, and certainly no doubt about that.
Yeah.
You outlined 6 criteria that investors should take note of when they're trying to pick the so-called great stocks for their portfolios. Share some weekend wisdom with us on taking us through those 6 criteria, maybe breaking them down into sections for us.
Yeah, really, I take a look at there's 2 groups of 3 criteria, okay? And one group is just your basic fundamentals, okay? We've done some research at my firm, and we find that things like valuation, stocks that are undervalued compared to their peers, and using things like PE or PEG can clearly show which stocks those are. Those stocks will tend to outperform their peers over the next 12 months. So valuation is a key. The other is management effectiveness, okay, which most people will measure that by return on equity. So how well does management use the assets of the firm to generate profits in the future? Are companies with higher ROE than their peers will generally outperform. And then another one is that if the brokerage analyst community sees good things going on at the company, and these people are very focused on fundamentals, they will upgrade the stocks. Stocks that have upgraded recommendations will generally outperform because it generally leads to further recommendations. And if you think about it this way, a brokerage recommendation is a kind of a marketing piece inside the firm, and they will get more of their clients to buy the stock. So stocks that are receiving more upgrades will generally outperform. So that's kind of the first set of 3.
All right. Second set?
A second set of 3.
They're a little proprietary?
Yeah, they're a little more proprietary to our firm. So, Zacks Investment Research, our founder, discovered that earnings estimate revisions are really the most powerful force impacting stock prices. And we can take a look at that on a few different levels. First, is the industry overall in good shape? Is the industry that a company is in feeling the growth of the economy and set to outperform. So using our Zacks industry rank, which is harnessing earnings estimates, are you in the right groups? Mm-hmm. Secondly, does the stock have what it takes for the long haul? Okay, so that's a little bit of a picture of what's going on in the past, how consistent have earnings been in the past, but really, are the earnings estimates steadily going up? And will that lead more likely to more earnings beats in the future and greater highs for the stock prices? Those kind of things can be found there. And then our short-term timeliness ranking, the Zacks rank, taking a look at the right now picture of what's going on with earnings estimates. The better that picture is, the higher the estimates are coming up, the more timely that stock's going to be to take off.
All right. Well, we appreciate all of that insight for us. You'll be back at the roundtable.
Absolutely.
We'll look forward to that. Stick around. There's more still to come here on Profit from the Pros. Here is your Bull and Bear Stock of the Week. A mining company and a private education company make up this week's Bull and Bear of the Week. Shiraz Mian, our research director, here with us once again to give us the reasoning behind each one. The mining company is Vale, and ticker symbol's VALE. Why is this a bull?
Two main reasons, Terry. Number one, this is the largest producer of iron ore in the world. It's a Brazilian-based mining company, by the way.
Okay.
And number two, the outlook for the demand and price of iron ore over the coming years is extremely good. So the improving and the solid outlook for commodity prices, particularly iron ore, primarily in the emerging markets, with a focus on China, is the primary reason why we have Vale as a top pick. On top of that, the company has a fairly robust plan to increase its production of iron ore. They have mining operations all over the world, not just in Latin America, and the plan that they have articulated to the market is a doubling of production over the next 5 to 7 years. So the outlook for the company's earnings, cash flows, and margins looks extremely good. And we see that in estimate revisions for Vale. And historically, we have seen that when estimates are going up, the stock price typically follows.
They've also benefited from a chain of small acquisitions.
They have. In fact, a few years back, they acquired this major Canadian company, Inco, for about 16, 17 billion. Mm-hmm. So they're not primarily iron ore. They have other non-ferrous metals as well in their portfolio, but about 90% of their EBITDA comes from iron ore, and that's why I was focusing on that. But they do have other metals in the portfolio as well. Okay. And the outlook for those looks equally good.
Strayer Education, STRA, the ticker symbol, is the bear this week. Why?
The for-profit education group has been under a negative limelight for the last 6 to 9 months, and that's primarily the reason for why we have a Strayer as well as the other for-profit education. We have a negative outlook for these guys. Specific to Strayer, they came out a week to 10 days back and telling us that their fresh enrollment for the winter quarter was extremely weak, significantly weak than what the street was looking for. And it appears that all that negative publicity and government scrutiny and new regulatory changes that are coming along, it's showing up in the enrollment number for Strayer particularly. In fact, the winter quarter new enrollment was down something like 20%, and we don't think that's a one-off issue. We think that the heyday of what these for-profit education companies did in the last couple of years is firmly behind them. They will be around, they will be part of the education mix, but not as lucrative and as profitable as they have been in the past. The government pays a lot of money for financial aid, and they are being more stringent in how they dole it out.
Okay, more Stock Talk is next. Stay with us. And now, Stock Talk, analysis of stocks in the news. Steve Jobs, co-founder and CEO of Apple, told his employees this week that he'll be taking another medical leave from the company. This naturally prompted some concern on the part of investors over the future of the company longer term and ultimately the future of the stock. So we asked our equity strategists, Tracy Reinick and Mike Vodka, to come on in and take a closer look at Apple with us this week. And let's start with the fundamental picture here. As a stock, as a company, the fundamental picture really isn't bad. It's pretty good.
No, it's really, really strong here. You really can't ask anything more out of a company than what Apple is doing. I mean, they have some of the hottest products on the planet, and they're selling tons of them. You know, they just reported after the news about him taking the medical leave, they reported their fiscal first quarter results, and they beat, again, for the gazillionth time in a row. They've beaten every time for 5 years, basically, which is a great track record given the recession and everything. They have a ton of cash on hand.
But here's something that maybe you can help shed some light on. Even though this is a great company fundamentally, the valuations are low, even by their own history in the company stock.
Yeah, I mean, they're not an expensive company here. You know, despite the stock price being where it's at, that's not what makes it expensive. They're trading around 17 times forward estimates, and those estimates are rising after the earnings. So it's going to get maybe even a little bit cheaper there. So yeah, I mean, it's not quite a value play that I would look at.
So is it a concern, though, that this great performing stock has these low valuations?
No, I wouldn't say so. You know, the stock is at, you know, I mean, no, I would say that, you know, it's doing what it should be doing, and investors are still buying, and it's just a good play right now.
Okay, Mike, what does the chart on the stock look like?
Well, as you mentioned, the longer term trend is very strong, tied into the fundamentals. But then on a shorter term basis, we've definitely seen a little bit of volatility slip into the share price on the Steve Jobs news. Shares were down about 3 or 4% on that news, but then they've recovered a little bit. We're pressuring a shorter-term trend line on a 3-month basis. So there is a little bit of uncertainty short-term, but taking a quick look at the longer-term trend, you can see that it's incredibly bullish, and this is a great company. There's no doubt about that.
And when you say taking a long-term look, how far out are you looking, time-wise?
Well, if you take a look at this chart that we're looking at right here now, this is about a 5-year chart, and you see the last 18 months, 2 years, Apple has ripped higher. It kind of ties into the valuation conversation you guys are having here.
Yeah.
I think the question is, you know, what's the next big thing for Apple? Prices are already very high. You know, how much higher can they go? That remains to be seen.
So I think on the investors' minds are, you know, number one, does Jobs have any kind of a long-term succession plan in place?
Right.
And since those details haven't been made public, really, all of this question surrounding how the company, how all of this, you know, health news might impact the company much longer term is probably what's weighing on investors' minds, right?
Right. The other times that this has happened, that weighed on their minds, but it's kind of the company's following the same procedure it did the last time, where, you know, the COO is stepping in, he's going to run it, and he did fine the last time. Yeah. Steve Jobs is actually staying on, they've said, to handle the design aspect and all of that for now.
Yep.
So while that's going on, you know, it didn't hurt him before, and so everyone is kind of knows this procedure.
So as long as they can keep good product in the pipeline, that might offset this concern in the investors' minds?
Yeah, on the short term. I mean, we're always going to have a longer term issue. So that is, you know, something for another day.
Okay, we're headed to the round table. Stay with us. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Taking the temperature of fourth quarter earnings season and what is in store for the stock market. All of that and top stock picks of the week, as always, with our panelists this week, Editor-at-Large Steve Reitmeister, Research Director Shiraz Mian, and top market technician Kevin Matris, all here at this edition of the Roundtable. Let's just go right down the line because we didn't have a chance to talk about this when we opened up the program. What's going on in your mind with earnings season? Overall, some upbeat news, a lot of big beats.
Yeah, I think that the actual earnings, you know, when people settle down and they really take a look at it, I think they're going to say this was a strong earnings season, not unlike October. But here again, not unlike October, September, stocks ran up so much into October that expectations were so overinflated, so we kind of chopped around in October. I think we're seeing the same thing here. December and early January was so strong that expectations here again are perhaps too lofty. So even though companies are beating, it's maybe not beating the higher whisper number type expectations, and some of the companies are selling off. But I think as people reflect back on earnings seasons, like, hey, corporate earnings are moving higher, stocks are still a pretty attractive place.
All right, Charles, what's your take on fourth quarter?
I think we are seeing a continuation of the trend on the earnings side that we have been seeing over the last 5-6 quarters. Getting into the earnings season, the expectation was for year-over-year growth rate of about 20%. My sense is that we would come, when all is said and done, north of 25% on the Q4, which would put us for the full year 2010 in the vicinity of about 50% growth. So an extremely impressive performance. We have all the key players out with their results, and I think the trend that we have seen up till now will by and large hold through the end of the earnings season. So I'm by and large impressed with the fourth quarter performance thus far.
Okay, Kevin?
Yeah, you know, it doesn't seem like a great earnings season so far with the market pulling back this week. But what's interesting is that last week when we were talking about earnings, I believe of the companies in the S&P at that time, 75% of those companies had already posted a positive earnings surprise. Now, if you take a look at this week, there's that many more companies that have reported, and up to this point of the companies in the S&P, 77% have posted a positive surprise. But what is very interesting is that 83% of those companies have posted a positive sales surprise. Now, granted, only about 10% of the companies in the S&P as of Thursday have reported so far, but a lot of the bellwethers have already come out, and so the season looks good, and if it continues in this vein, I think it's going to be another great earnings season.
Okay, you had to mention that knockback in stocks this week, didn't you? Right. So, because he mentioned it, Shiraz, and since you're closest to him, I'm going to just ask you, and I'll come to you too for your take on this. Is this the correction that everybody was waiting for?
I don't see any reason for the quote-unquote correction in the market. I think there is reason to believe that we need to see some strength in the underlying economy for the next leg of strength in the market. But that doesn't mean that the market needs to come down. If we don't see that strength, for example, next month or next week. So my expectation for the market is that if we don't see a positive number on the jobs number, for example, then the market just basically kind of meander around this level and maybe drift a little bit lower, but I'm not looking for a correction.
What do you think about that, Steve?
Yeah, I mean, you know, right now we're at Dow 11.75, 11.8, whatever it is, somewhere around there. And so if I were quickly to say, are we more likely to hit 12,000 or 11,500 first? I'd say 12,000. Now, at 12,000, it probably stalls out for a while. It's going to be a little bit of resistance there, and it's going to be hard to get above for a while. But here again, so chopping around after the market has rallied 20% since the end of August, hard to complain about that. But on an individual company basis, with each earnings report, I mean, people are going to either beat expectations and go higher, or if they do come in under, they're going to get beat up severely. So that's where you're going to get a lot of that choppiness. So hopefully you got a good lineup of stocks that are likely to beat, or else it's going to be a pretty ugly next month.
Right. Kevin, what about the longer term here, though?
Yeah, well, first off, short term, I think that we still are on target for around 12,250. Okay. If we were to see a pullback extend a little bit larger than what we've seen so far, I got a hard time making a case for it to go below 11.5, and that's only about another 2 or 3% from where we are. But longer term, I really do believe that we are on our way to 12.5, 12.8, and possibly even 13.1. which is where we were back in 2008. That's another 7 to 10% from here. And I really think that with all the good things happening out in the economy, I think that's where we're going.
13.1, it's a little aggressive.
Yeah.
It's you know, if you really, I mean, you take a look at the year-end forecast for most folks, 13.1 is not that aggressive.
Right.
So it sounds lofty from here, but
Yeah.
if you go out this year and you continue to have the economic rebound, you continue to have the healthier earnings as we seem to have, 13.1 is not that lofty, and really that would only be a PE of about 14
Right.
On stocks. That's not overvalued by any stretch.
Right.
All right, I stand corrected. Give us your top stock pick.
I'm going with MKS Instruments. Given the strength of Intel and IBM earnings, obviously a technology space is in very good shape. This maker of semiconductor testing equipment is in very good shape. They rose 7% after the Intel earnings report, so definitely people see them as being a good space. I really like the growth trends and think this share is going to easily be 20-30% higher.
All right, Shiraz.
My pick is also in the tech space, but it's on the software side. VMware is the ticker. It's in a very hot trend right now in the IT space called cloud computing. VMware is a leader in the virtualization space, and they have about a 75% market share in the server virtualization. So very well placed right now.
Okay, I got to move. Kevin.
Mine is KBR Incorporated, ticker KBR. Really quick, they are a construction company. They do a lot of things with energy, government services, this kind of thing. I believe they have a price target of 36. That is a 15% gain from here. I think they look great.
Interesting. Is that a comment on the home builders, the home market?
Actually, they do more things like government services. They work in hydrocarbon, this kind of thing.
Okay.
Yeah, not home builders.
Okay, great. Thank you all for being here, and thank you for being with us as well. Hope the week ahead is a profitable one for you. We'll see you next week on Profit from the Pros.